Welcome. My name is Mauricio Mena, and I'm in John Crescent's Finance 381 class, and today I'll be presenting my project presentation based on financial analysis. Throughout this presentation, we'll be answering three main questions. 1. Which two companies would you give a 6 months loan for $50,000? 2. Which two companies would you give a 5-year loan for $500,000? And 3. Which company will you buy equity on? In order to answer all three questions, we're going to be analyzing 5 different companies from 5 different industries with the help of different financial ratios, such as liquidity ratios, debt ratios, and profitability ratios. The 5 companies I decided to use for these presentations are Molson Coors Brewery from the adult beverage industry, Spectra Energy Partners from the oil and gas industry, Boeing Corporation from the defense industry, Medtronic plc from the medical industry, and Textron Inc. from air and parts industry. Alright, so in order to answer the first question of to which two companies you would give a 6 month loan for $50,000, we have to analyze the short-term solvency of these companies. The reason we want to analyze the short-term solvency is because it serves us as a measurement to measure a company's ability to repay back its short-term obligations. Also, it helps us, the investors, to make smarter and wiser decisions when it comes to investing our money, as it gives us a clear idea to which companies are going to be able to repay back that money they borrowed from you in the time they promised. In order to analyze short-term solvency, we're going to be using 3 different liquidity ratios. The first ratio we're going to be using is going to be current ratio. Current ratio can be calculated by taking current assets and divided by current liabilities. And it pretty much measures a company's ability to pay off its current liabilities within a year with its current assets, such as cash, accounts, receivables, and inventories. The second ratio we're going to be using is going to be quick ratio. Quick ratio and current ratio are pretty similar. The only difference is that quick ratio subtracts inventory from current assets. And this is because quick ratio measures a company's ability to meet its short-term obligation with its most liquid assets. The third ratio we're going to be using is going to be cash ratio. Cash ratio measures cash and other equivalents that cover liabilities. Alright, so if we analyze the current ratio table, we can see that Molson and Spectra for the last 5 years, they have had a current ratio below 1. This means that Molson and Spectra cannot repay back its short-term obligations. For example, if we observe Spectra in 2018, we can see it had a current ratio of 0.59. This means that for every dollar they owe, they only have 59 cents to repay back. On the other hand, if we observe Boeing, Medtronic, and Textron, we can see that these 3 companies have had a current ratio above 1 for the last 5 years, which means that they're more than able to repay back its short-term obligations, and it will also suggest efficient management of working capital. Out of these 5 companies, we can see that Medtronic is definitely the one with the highest current ratio with a 2.28 in 2018, and following will be Textron with a 2.04 in 2018. We can also see that these 2 companies has been extending for the last 5 years. We can see that Medtronic started with a really high current ratio in 2013 of 4.52, and it has a slowly decreased over the years, and it currently has a 2.28 in 2018, meaning that for every dollar they owe, they got $2.28 available to repay the money. Second in place, we can see Textron in 2018 with a 2.04. Also, we can see that Textron has increased little by little over the years. We can see how it started with 1.87. It kind of decreased a little bit in 2014, and then it picked up back in 2015 and slowly increased to 2.04 in 2018. For the current ratio, I think that Medtronic and Textron are definitely the best 2 companies. Another thing that keep in mind in later investment is that we don't want companies with a really high current ratio. For example, current ratios of 40 or 50, because high ratio may indicate too much working capital and efficiency. Alright, so if we analyze the quick ratio table, we can see that most of these companies had a ratio below 1 for the last 5 years. A quick ratio below 1 usually shows or indicates liquidity problems. So we can see that the only company that kind of outstand it, like out of all of them, was Medtronic. That that for the last 5 years they had a quick ratio above 1, which pretty much shows efficient management of working capital. We can see that even though we kind of decreased throughout the years, it ended up in 2018 with a current ratio of 1.71, meaning that the company has enough money to repay back its short-term obligation with its most liquid assets. So out of this category, out of this ratio, I would say that Medtronic is definitely the one that excels and beats all the other companies. They have good liquidity, a lot of cash in hand to cover its current liabilities. If I had to choose a second one to follow Medtronic, it will be Textron. It has the second highest of 0.54. Alright, so when analyzing the cash ratio of these five companies, we can clearly see that four out of the five companies, except for Medtronic, had a cash ratio below 1 for the last 5 years. This pretty much means that all these four companies, Molson, Spectra, Boeing, and Textron, had insufficient cash on hand to pay short-term debt. On the other hand, if we focus on Medtronic, we can see that even though it has decreased over the years, Medtronic has been able and managed to keep a cash ratio above 1 for the last 5 years, meaning that Medtronic had enough cash to cover its current liabilities. If I had to pick the top two for the cash ratio, I would definitely choose Medtronic, as it's clear that it has a cash ratio above 1, and then it will be Textron, as it possesses the second highest cash ratio. Alright, so answering the first question of who would you give a 6 month loan for $50,000, I would definitely give it to Medtronic. Medtronic was definitely the company that excelled out of all the other companies. It had the highest current ratio, quick ratio, and cash ratio, which indicates that the company is more than capable to pay short-term obligations, and it has also great management of working capital. The second choice would be Textron. Textron had the second highest current ratio, quick ratio, and cash ratio, which indicates that Textron has great management of working capital and it has enough current assets to cover its current liabilities. Alright, so moving on into the second question of to which the companies you will give a 5 year loan for $500,000. In order to answer this question, we have to analyze the long term solvency of these companies. In order to do so, we're going to be analyzing and using two different ratios. The first ratio is times interest earned. Times interest earned is a metric that measures a company's ability to meet its debt obligations. Times interest earned indicates how many times a company can cover its interest charges on a pre-tax earning basis. The second ratio we're going to be using is going to be the equity multiplier. Equity multiplier is commonly used in financial ratio that measures the amount of a firm asset that are financed by shareholders' equity. Equity multiplier shows the percentage of assets that are financed or owned by the shareholders. A high equity multiplier would indicate that a large proportion of assets financed is attributed to debt. So the lower the equity multiplier, the better. Alright, so when analyzing times interest earned, it's really important to keep in mind that higher times interest earned ratio is favorable because it means that the company presents less of a risk to investors and creditors in terms of solvency. Also, companies that have a times interest earned ratio less than 2.5 are considered a much higher risk for bankruptcy, and therefore they are seen as financially unstable. If you observe the table of times interest earned, we can see that Medtronic and Boeing excel in comparison of the other three. we can see that Boeing have a times interest ratio of above 20 for the last 5 years, which is kind of impressive. On the other hand, Medtronic had a high times interest earned above 10 in 2013 and 2014. However, in 2015, it kind of started decreasing and it kind of picked up again in 2018 with an 8.11, which is not bad. Pretty much meaning that for every dollar interest they owe, they have $8.11 to cover it. So pretty much they can cover that dollar 8 times if they want it. Pretty much saying they have enough money to pay back its long-term debts. Furthermore, whenever analyzing for equity multiplier, it's really important to keep in mind that a high equity multiplier indicates that a company is using debt and other liabilities to finance its assets, making a company riskier to invest in. Boeing is a clear example of this. We can see that it started with a equity multiplier of 8.75 in 2013, which was almost twice, 3 times as high as the other companies. However, we can clearly see that in 2017, the equity multiplier skyrocketed from 25.78 in 2016 to 155.57 in 2017. This pretty much means that the company make a huge promise and they got a lot of debt. Pretty much they borrow so much money for a new project or anything that we're launching. And pretty much this means that they have so much promise and debt they have to repay back. The investing in them will pretty much be a bad idea and really risky, as pretty much they won't be able to repay you back because they won't be able to have enough money to cover all its liabilities. On the other hand, we can see that a low equity multiplier usually indicates that a company is less of a risk as they don't have too many debts to repay. And this is pretty much what we want. We want a company with the lowest equity multiplier as possible, and this pretty much will give them more room for them to repay us back whenever we give them a 5 year loan for $500,000. So when looking at the table, we can clearly see that Medtronic has the lowest equity multiplier in comparison of the other five companies. We can see that for the last 5 years, he has kept an equity multiplier below 2. On second place, we can see that Spectra has also kept the equity multiplier below 2, which is good, which means that these two companies don't have too many debts or obligation to repay, which means if you ever loan them money, they will be more than able to repay you back. So, answering the question, who would I give a 5 year loan for $500,000? I would definitely give it to Medtronic. Medtronic has again proven to be an amazing company. It has proven to know what they're doing, both in managing their working capital and their promises and their debt and their risk levels and everything. So, Met- Medtronic will definitely be my top one choice, especially because through the ratios we use, it was the company with the highest times interest earn ratio, which indicates their ability to repay back their debts, and it possessed the lowest equity multiplier among the other companies, which indicates the company with the less risk, as it has the fewer promises and fewer obligations to fulfill. The other company I will extend a 5 year loan would be Textron. Textron also showed to have a high times interest earned, which indicated that they're more than suitable to repay back their loans and obligations. And also, it managed to have a low equity multiplier, which means, again, they didn't have a lot of obligations or promises. So, repaying back the loan for 5 years for 500,000 wouldn't be an issue for them. Moving on into the last question of which company is the best to invest in. In order to answer this question, we're going to analyze four different profitability ratios in order to find the best company to invest in. The first ratio we're going to be using is going to be profit margin. Profit margin is pretty much net income divided by net sales, and it gives us a percentage amount that measures how much out of every sales dollar a company retains as earnings. The higher the ratio, the better. The second ratio we're gonna be using is gonna be total asset turnover. Total asset turnover is pretty much an efficiency ratio that measures a company's ability to generate sales from its assets. The third and most important ratio we can use in order to analyze what company or which company is the best to invest in is ROE. ROE is pretty much net income divided by equity. And ROE analyzes the profitability of a company by looking at how much profit a company can make with its shareholders investors. Finally, we're going to be also analyzing the ROA of these companies. ROA shows how profitable a company is based on their ability to utilize their assets to generate revenue. Alright, so moving on into profit margin, as I was saying, we're trying to find companies with the highest profit margin. We can say the higher, the better. As profit margin is pretty much an indicator of a company's pricing strategies and how well they control costs, and it also indicates a strong company's profitability. So if we observe the table, we can clearly see that Spectra excel in this area. We can see that for the last 5 years, Spectra placed number one and compared to other four companies in profit margins. We can see in 2018, it has a profit margin of 30.45, which means that for every dollar they create in sales, they retain 34 cents, 34.45 cents. The second, the second to Spectra is Molson. Molson, we can see that for the last couple of years, it had a profit margin above 10%, and we can see in 2016 this profit margin skyrocketed from 10.08 to 4.8. So out of all these companies, we can see that Spectra and Molson are the most profitable one with the highest profit margins. Alright, so when analyzing for that total asset turnover, it's really important to understand the ratios and what do they mean. For instance, a ratio of 1 means that the company is generating $1 of sales for every dollar they invested in an asset. So when looking at the table, we're looking for companies with the highest total asset turnover. As higher turnover ratios mean that the company is using its asset more efficiently. So we can clearly see that Boeing is the top one company with the highest total asset turnover in comparison to other companies. We can see that for 3 years in a row, from 2015 to 2017, it kept a total asset turnover of above 1. Second to Boeing, it will be Textron. Textron, we can see it has been really constant with the total asset turnover ratio. We can see for the last 5 years, it has kept a total asset turnover ratio of above zero point 0.9. However, on the other hand, if we look at Spectra, we can see that for the last 2 years, 2017 and 2018, it had a total asset turnover ratio of 0.09. This pretty much means that Spectra is not using its assets efficiently. It's not using them at their maximum potential. It's pretty much saying that for every dollar they invest in an asset, that asset is only generating 9 cents, which pretty much shows inefficiency. As I was saying, ROE is the most important ratio when it comes to determining if we should invest in a company or not. ROE pretty much analyzes and measures how efficient company uses their investors' money to generate money. Therefore, a higher ROE is desirable, as high ROEs indicates a company ability to generate money and cash internally. If we look at the table, we can see that Boeing is definitely the company with the highest ROE. We can see in 2018 it has an ROE of 1400. We can see this ROE kind of skyrocketing from 2016 to 2017 when it moved from 136.88 all the way to 1398.81. This is kind of crazy in my opinion, and I would really put my eye on it as um as we saw the equity multiplier. We can also kind of skyrocket through these 2 years too from 2016 to 2017, which means that the company got in a lot of debt and a lot of promises. Pretty much, it will mean that the company was investing in a new product or a new launch, and they borrowed a lot of money in order to make it happen, which increased the equity multiplier and the risk as the promises and debt increased. Also, debt is also known to boost ROE. So pretty much would be that the reason the ROE is so high is because they borrow so much money that they produce so much revenue and sales that's why their ROE kind of skyrocketed. So if I would have to choose the top one company with the highest ROE would be definitely Boeing. As you can tell, we has a ROE of 1400 in 2018. Second to Boeing would be Molson, as even though it's kind of started lower than anybody else, we can see that slowly over time has increased. We can see how it went from 6.85 on 2013 all the way to 11.74 in 2018. So we can see that Molson return on equity is constantly increasing, which is a good sign. Also, we can see Medtronic. We can see that Medtronic started really high with really high equity return on equity, but we can see as the years went by, the return on equity kind of started decreasing. We can see Medtronic went from 19.38 in 2013 all the way to 6.15 in 2018. So I will kind of keep an eye on Medtronic as it has been a really good company in other ratios, current ratio, cash ratio, quick ratio, equity multiplier, and etc. But we can see that its return on equity is constantly decreasing, which means they having they're having difficulty generating money cash internally, or that they're not using their investors' money efficiently. So as I was saying before, top one Boeing and top two, I would say Molson has a really good return on equity and a lot of potential in the future. Moving on, when analyzing the return on assets of these companies, we want a high ROA. The higher ROA indicates how efficient a company is in using its assets in generating sales. So when looking at the table, we can clearly see that Boeing has the highest ROA in comparison of the other companies. We can see that it has constantly increased throughout the years. We can see that in 2013 it had a ROA of 5.05 and it increased all the way to 9.08 in 2018. Second to Boeing, I would say it will be Molson again. We can see that Molson is constantly increasing back and forth, but eventually is ultimately increasing over time. We can see in 2013 it started with a return on asset with a 3.57, and then it kind of skyrocketed in 2016 to 9.58, and it kind of lowered down to 4.92 in 2018, but still making an increment from the 2013 all the way to 2018. So I would say Boeing has definitely the highest ROA and Molson is the second highest. So in answering the last question of which company is the best to invest in or which two companies I'll buy equity on, my answer would be Molson Coors and Boeing. The reason I chose Molson Coors was because of their high profit margin comparison to other companies. We can see for the last 5 years it had a profit margin of above 10%, which is really good. Also, it had a high ROA, which is it showed its efficiency with its assets. Furthermore, the reason I chose Boeing was specifically because of its ROE. We can see in 2018, Boeing had an ROE of 1400, and that's pretty much every investor's goal. Finding a company that uses their money efficiently and effectively in order to produce more money so they can have more money in return at the end. And Boeing is definitely doing that. Also, Boeing showed a high total asset turnover in comparison to the rest of the companies, indicating its efficiency of producing sales and revenue with its assets. Well, this is the end of my presentation. I hope you enjoyed. Thank you.